Sorry, guys. So I got a couple of good questions. One is, do we always need to imply cost of sales, or won't we know cost of sales? And so I think the correct answer is it's possible to know your exact number of cost of sales if you have a good inventory system. But a lot of companies, what they do is even if they have pretty good inventory systems, they'll still at the year end count, and they'll adjust their books to match that count. Okay, so it's almost like the physical good takes precedent over what their records say. If there's a difference, they want to understand why, but they'll almost always book to what's in the inventory, the physical inventory. Okay, so another good question I got was, how do we know what the value of the ending inventory is? So that's what we're going to cover now. This will also be tested, so it's important. So these are called inventory costing methods. How do we determine what the cost of the inventory is versus the cost of the sales? Because up till now, we've just given you the number. We've said ending inventory is 1,000, right? And then you can work backwards and figure out what cost of sales is. There's 3 methods: specific identification, first in, first out, also called FIFO, and weighted average. So again, the total dollar amount of goods available for sale, we start with this number here. Based on the inventory costing method, it determines how much moves to ending inventory and how much moves to cost of sales. Okay. The specific identification method is the kind of the most logical, straightforward method, and it's usually used for big ticket items. So cars, jewelry, houses. It's called specific identification because you can specifically identify how much, if you're a Ferrari dealer, you know how much that Ferrari cost you, right? You spent however many $100,000 to buy the Ferrari, and then you sold this one Ferrari. You're not making 1 million Ferrari sales a day, right, where you can't even keep track of it. Same for jewelry, same for houses. If you're a housing developer, you know how much it costs you to build each house. And the sales don't happen all that frequently. You might sell 50 homes in a year, right? So it's easy to keep track of what did you actually sell, right? You sold this specific diamond, this specific car, this specific house. So when that specific unit is sold, the cost moves from inventory to cost of sales. The other 2 methods, you need to make some assumptions around how costs flow. Okay, and so this is FIFO, which is number 2, and weighted average, which is number 3. And this inventory costing method is not based on the physical flow of goods on and off the shelves. And that's because it's often impractical for a company to maintain an individual barcode for every single inventory item, right? So you'll see how these methods work. The first in, first out method works like a line, like you're getting in line to buy pizza or something. If you're first in line, and someone gets in behind you, you're going to get your pizza before them, right? If you enter the line and there's 10 people in front of you, as each person gets served, you move closer and closer to the front, right? Except instead of you, it's a cost. It's a dollar amount. So the oldest costs, meaning the costs that have been in line the longest, move to cost of sales. They get out of the line eventually. The recent costs, those people that just got in line, sit in ending inventory. If I were to say at midnight, are you in inventory or cost of sales at Campus Pizza? Cost of sales would be you got your pizza and you left. Ending inventory would be you're still in line at midnight. So here's an example. And so this works for some reason the textbook publisher used mousepad inventory. Nobody even has a mousepad anymore. But imagine you're purchasing raw goods, right? Let's say you're buying copper. The price of copper changes drastically, right? Every day the price is different. You might buy copper over a 6-month period, and you'll pay drastically different prices every time you buy a shipment, okay? The problem is copper, it's a commodity, right? It's all the same in theory. When you buy it, you're buying the same type of copper, processed the same way. So the question is, okay, so you start with beginning inventory, you know you have 1,000 units of copper, and okay, why don't we call this, is copper traded in ounces or pounds or kilos? I don't know. Any engineers? Okay, we'll call it ounces. That might not be right. And you paid $5.25 an ounce. You spent $52.50 to buy 1,000 units of copper. And then you made some purchases throughout the year, right? You bought, on January 3rd, you bought 500 units, but here the price you were paying was $5.30. On June 20th, you purchased another 300 units, and here you paid $5.60 a unit, right? So you can see how these prices are fluctuating, and every time you're making a purchase, you're paying a slightly different amount, right? And you're making purchases throughout the year. You know that your beginning inventory plus everything you've purchased should give you the total goods available for sale. So let's say you purchased 2250 units of copper, or rather you purchased 1,000, or you started with 1,000, you purchased 1250, therefore you had 2250, and the total cost, you spent $12,210 to buy all that copper. You know you only have 1,200 units left, okay? And so your cost of sales is $10.50. You sold $10.50, or you used $10.50 in producing a phone, okay? And your ending inventory is 1,200 units. So the question is, how do you know of this 1,210 how much, what the dollar amount of the ending inventory or cost of sales are, right? So here's where it's important to recognize the difference between first in, first out and weighted average. So under first in, first out, here, let's look at the wording here. The cost of the most recent purchases are in ending inventory. They're still in line, okay? So there's two ways to go about this. One is you can say, which of these units of copper are still sitting in inventory, in theory. Now, again, this is the copper. You can't tell the difference between what was purchased January 3rd and what was purchased November 29th. They're identical. You don't know the difference, right? All you care about is identifying the cost of those units, which does differ. So if you want to know the value of this ending inventory under the FIFO, you're going to say that anything that was recently purchased is still sitting there in inventory. It's still in line. So how do we get to 1,200 units? Well, in this case, they say, let's start with 11/29, which is November 29th, and keep adding units until we reach the number in ending inventory. So we're going to say that to get to 1,200 units, we take this one, 200, now we're at 450, now we're at 750, and we take part of this, because 750 plus 500 is 1,250. So we're going to take 450 units from the January 3rd purchase. So this is given information, right? And all this, the units and the dollar amounts just come from here, units and dollar amounts. What we're saying is ending inventory, newest cost, we're going to start from the bottom and work our way up until we hit 1,200 units. And we know the cost of each of these purchases, right? We know that we spent on September 15th $5.80 a unit, or $14.50 to buy the 250 units. And so what happens if you multiply all these out, 450 times 530 plus 300 times 560 plus 250 times 580 plus 200 times 590, you're going to get to this, 66.95. That's the cost of the ending inventory. Now you know that your goods available for sale was worth 12,210. So you could take 12,210 minus 6695, and that'll give you 55.15. You can check your work to make sure you got it right, because you know that by definition, whatever's not in ending inventory was assumed to be sold. You assumed, so we know that we sold 1,050 units. Based on FIFO, we say the units that had been there longest were assumed to have exited inventory. So we sold the remaining 50 units at 530 here from the January 3rd purchase, and then we sold all of our beginning units at 525. So if you take 1,000 at 525 plus 50 times 530, you'll get to 55.15 for 1050 units. So the good thing about these types of problems is you can work two ways to get the same answer. You could have directly calculated cost of sales, right? Because you know that instead of starting with the oldest inventory or with the newest inventory, you just start with the oldest inventory. And you know you sold 1050 units. So you can just work backwards and say, well, my cost of sales is 55.15. Therefore, my cost of sales or my ending inventory must be worth 66.95. And so you can check your work and say, well, what if I add all the units that I think are still there? Do I get to 66.95? So you should always kind of balance and reconcile, right? This sort of logic works for, again, homogeneous goods. If you have copper and silver, you're not going to combine them together, right? Because they're two different things. Now, I got a good question on, I actually don't know if we're covering it. Just give me a second here. Weighted average. I don't think we cover it. So the question was, so how do you know all those direct costs, the overhead, your employees working? We said all that gets booked to inventory, right, to purchases. All that gets embedded in the total here, okay? And you can actually imply the dollars per unit, because you might have total 2650 divided by 500 units gives you 530 a unit. So you might have only paid $5 a unit, but you allocated all these other costs to that purchase, and you know that you have to capitalize them before you sell, right? You can't expense them. So that's how all those other costs sort of get baked in here. Another thing to note is, in this case, we're talking about ending inventory and cost of sales. But the exact same logic applies to, if you're a manufacturer and you start with raw materials, you care about the dollar amount of your raw materials moving to WIP, moving to finished goods. So you could think of this as rather than starting with ending inventory and cost of sales, you could call this raw goods and WIP. Because again, it'll move to the extent that you've completed it. You say, oh, we've produced, or we've started producing 1050 units of WIP. So we're going to move the cost of that copper into the work in progress. So it helps you keep track of the costs and how they're flowing. Notice, because these goods are homogeneous, we can't really keep track of when they came in and when they leave from a physical perspective. I'm not saying that this ounce of copper was from our beginning inventory. It might have just come in the door today. But the cost we're assigning to it is the cost from our beginning inventory. That make sense? So this is just a summary. You can sort of work out the math yourself that make sure it all works, right? So notice this 12 to 10 is just the sum of these two. Average cost method, or weighted average cost method, now, you've probably all encountered the difference between a simple average and a weighted average, but I'll give you an example. The way this grade is calculated in this course, if you got 80 on the midterm and 70 on the assignments and 90 on the final, your grade's going to be pretty good, right? Because I'm going to weight the final 80% and then 10% midterm and 10% assignment. So your grade would probably be, I don't know, like 86 or 87 or something like that. If I said your final is worth, or you got 90 on your final, you got 80 on your midterm, and you got 70 on your assignments, and I just took the simple average of those three numbers, your average is going to be 80, right? So weighted average means you apply some sort of percentage or preference to one of the inputs. So it's called weighted average, and I'll show you why. Because, I mean, the way it works is you're going to give preference to the units that you purchase more of. And that's just how it works out. You don't actually need to do it. The arithmetic does it for you, but it's not a simple average of these. It's not taking the average of 525, 530, 560, 580, 590. Because you can think of these units as being the weights. If you have 2250 of goods available for sale, this beginning inventory is worth, what, 40%, right? Think of this as like the midterm. And then each of these are sort of smaller. So therefore, this beginning inventory, this 525, is going to have a greater impact on your weighted average cost. So let's go back here to the methodology. When a unit is sold, the average cost of each unit in inventory is assigned to cost of sales. Okay, so you have cost of goods available for sale divided by the number of units available for sale will give you a cost per unit. Okay, and then your ending inventory is just the number of units you have times the cost per unit, average cost per unit. Your cost of goods sold is just the units you sold times the same average cost. Okay, so let's see how that looks in practice. So the weighted average cost, you spent $12,210 to buy 2250 units of copper. Each unit of copper cost you 5.43. So I want to mention something about rounding on the midterm. So I got a lot of questions about, do I have to round, is 4.001, do I round that to 4.01 or 4.00? And frankly, I'm indifferent. The only reason I put round your numbers to 2 decimal places is because historically I haven't, and I get the question, do we round up or down or how many decimals? I appreciate in science courses and certain math courses, decimals are very important. For accounting, it's more, if you put 4.01 and the answer was 4.00, you're definitely getting full marks, right? It's clear that you know what you're doing. Even if you just put $4 even, it's clear that you got the right answer. So don't get too hung up on 4.2667 versus 5.43. If it's evident that you used the right calculation, we're not going to penalize you at all, okay? So in this case, what we're saying is each unit is worth on average $5.43, right? That is not just the simple average of these units. You have to take the totals. If you wanted to make your life harder, you would take the units as a percentage of total, like I did here, 40%, and then let's call this 10%, let's call that 20%, and then apply that weighting to this unit, and then multiply them out. But simply taking the total, sum the total, and sum the units will give you the weighted average cost. On the midterm, you will have to calculate the goods available for sale. It won't be given to you, but you will be given this information here in white. Okay? So now, we know that ending inventory was 1,200 and cost of sales was 1,050 in terms of the units. So we apply the same, notice how these are the same, we apply the same average cost per unit just to the units in inventory and the units sold. Now here's the thing, these are going to give you, I don't think they show an example, these are going to give you, slightly different numbers. Ending inventory under the weighted average cost method is 65.12. Under the FIFO method, it's 66.95. Not that big a difference, but depending on the numbers you're using, you can get really big differences. Now, of course, if your ending inventory is higher, your cost of sales is going to be lower, right? In this case, ending inventory is lower, cost of sales is higher. We're still getting to the same goods available for sale. It's just how we're allocating it. So here's a comparison of the how each method impacts the income statement. Net sales shouldn't change, right? We still sold however many phones or however many units of copper if we're a copper buyer and reseller. We still recognize revenue for 25 grand in this case, right? However, our cost of sales were different, and therefore our gross profit was different. Our OPEX, our operating expenses, are the same, but our earnings before tax are different, and therefore the income tax expense is different. I got this question a lot on one of the first assignments. How is income tax calculated? Income tax is calculated, it's the last item before net income, and income tax is calculated as a percentage of your earnings before income tax. All your profit up until the point the government takes some money from you. If you have lower profit, you pay less tax. Okay, so if you have higher expense, you're going to have lower profit and therefore pay less tax. So net earnings in this case are different by, what is that, $28? Not that much different, but there are differences. So here's another point. In periods of rising prices, FIFO results in the highest ending inventory. Okay. So if we go back here, if copper prices were rising, which in this case they are, they're going from 525 to 530, 60, 80, 90. Because of how we account for ending inventory, the highest costs are sitting in the ending inventory. And our cost of sales represents the stuff we bought cheaper at the beginning of the year, right? What does that mean to have higher ending inventory? That means you have lower cost of sales, which therefore means lower or highest gross profit. We pay more income tax because we have more profit, and therefore we have more net earnings because we have lower cost of sales. So just understanding the impact that, notice how there's no right answer here, right? One could argue for either method, right? You could say it makes more sense if we're selling the older copper first, or it makes more sense to take a simple average. But notice how the impact is, you can sort of distort the earnings a little bit. If you're a manager, you might want to show this FIFO. You might want to show, oh, we're at 13 million of net earnings versus 12 million. If your bonus target is 13.1 million, you're going to hit your bonus under the FIFO method. Under the weighted average method, you won't. Now, most of the time, you're not going to be that close, but it just goes to show how you can distort earnings just by choosing how to account for something, right? Advantages of methods, first in, first out. Ending inventory approximates current replacement cost. So that's an interesting concept. If you're a user of the financial statements, and you might want to know if there is a fire or theft, or if we sell what's in our inventory, how much is it going to cost us to refill that inventory? And because your FIFO represents the most recent costs, your inventory under FIFO represents the most recent costs, that's a better approximation than if you have inventory that's been sitting there since the beginning of the year. Maybe copper prices have doubled, right? And it's going to cost you a lot more to replace that inventory than it once would have. You want to be able to see that. The alternative is the FIFO method is volatile compared to the weighted average method. The weighted average method, it'll smooth out a price change, right? Because you take the weighted average over a year, over a period of time. You don't need to know much about this, but there's a third system called LIFO. LIFO is last in, first out, and it works the opposite of FIFO. LIFO is kind of a counterintuitive system whereby you get into the back of the line at Campus Pizza and you get served first, right? That doesn't really make sense. People who have been standing in line will continue to stand in line indefinitely. So of course that's a problem because you might have inventory sitting on your books at a cost and they've been there for 2 years. That's nowhere near the approximation of what they would actually cost to replace. Not to mention, it doesn't really make sense. You've probably sold that inventory by now. So IFRS does not allow LIFO. US GAAP does. That's all you really need to know. So there's a choice of inventory methods. If you're a manager, you want higher net earnings, but you also don't like paying tax. So if you have higher reported net earnings, you're going to pay more tax. So there's a balance between how much tax you actually pay. Now, so here's the thing. You report net earnings, your statement of cash flows is not affected, right? Remember how the statement of cash flows will always get you to your true ending cash. So if you were to report higher net earnings, that's not going to come through your cash flow statement. But if you report higher net earnings from an inventory perspective or a cost of sales perspective, if you report higher net earnings, you're going to pay more tax. That actually will be more cash out the door. You're going to have to pay the government a little bit more tax. That will bring down your cash balance. So it's a consideration of, do you want more cash in your pocket or do you want to report higher earnings? Okay, so that covers inventory costing. Any questions before we move on? We're going to do an example question of it. Seem good? All right. So one of the accounting rules is called valuation at lower of cost or net realizable value, LCNRV. And so to be accounted for at the lower of something means look at the two numbers. If you have one number is 100 and the other is 120, which is lower? 100. It's sort of like a min function, like a minimum function, right? If you were to say minimum of x and y, and this is x and this is y, you're going to get 100, right? And so that's just for being conservative. So we know what the cost is. The cost, we just spend a lot of time calculating. The question is, what does this represent? Net realizable value. Net realizable value is the expected sale price less estimated selling costs, repair and disposal. I'm not going to focus too much on the selling costs. And then the company will recognize what's called a holding loss in the current period rather than the period in which the item is sold. So let me give you an example. Let's say you're Walmart and you bought a ton of ePhones. You bought 100 ePhones and they each cost you $1,000. You spent $100,000 on ePhone inventory. And the next day, Apple comes out with a new phone and nobody wants ePhones anymore. You have this inventory that's sitting on your books for 100 grand. Maybe you'll be able to sell it in the future, but you thought you were going to be able to sell it for 150 grand, right? You're going to make a profit off it. Now you expect you're going to have to sell it at a loss. Maybe you'll only get 75 grand for it. So the question from an accounting perspective is, do you wait until the sale is made? Normally accounting, we force matching, right? We say you have to match the expenses to the revenues. So if you were to make a sale and you would sell, let's say you offload all the phones at once for 75 grand, then you'd recognize the cost of goods sold as 100 grand, you made a loss of 25. The accounting rules are very conservative in that they say if you think you're not going to be able to recover at least your cost, you have to take a loss today when you realize you're not going to be able to sell it. So let's say December 31st comes along, Christmas sales are done, we realize nobody bought these phones, we realize, okay, we're going to offload them next year. The accounting rules say you have to first figure out how much you think you're going to lose, and then you have to record that today. The accounting rules don't let you do the reverse and take a gain. If you think you're going to sell something for a gain in the future, you're not allowed to take it today. Okay, so that's what they mean by prudence or conservatism. Accounts are more willing to take a loss today. We'll accept that, and it gives a better picture of the business, right? If you were to see the inventory was sitting there at 100 grand versus 75 grand or 75 million, however much it is, that'll give you some different information, right? If you see in the income statement, they're going to book a loss, holding period loss on the inventory of 25 million, you know that they made a purchase, they basically made a bad decision, right? They bought all this inventory and they're not going to be able to realize enough for it. So here's an example. Let's say this company buys jackets and handbags. They have 1,000 jackets and 400 handbags. The jackets cost them $250 a piece, and the net realizable value is $200. So they bought these ugly jackets and nobody wants them, so they have to sell them at a discount. So the lower of cost or net realizable value is $200, and therefore the total LCNRV is 200 times 1,000. Handbags, on the other hand, we bought 400. They cost us $100 each. We'll be able to sell them at a profit. LCNRV is 100, and therefore the cost is 40. And that cost is, we're not making any adjustments there. That's just what we purchased it for. So our cost is 290. Our LCNRV is 240. We effectively have to increase our cost of sales for this year, even though we haven't made any additional sales. We have to recognize higher cost of sales today for 50, which is the difference between the cost and the LCNRV. You can look at it like we're making an adjustment to make sure inventory is recorded correctly. We know that inventory has to be 240, and it's sitting at 290. So we have to credit it by 50. The debit has to go to cost of sales. You can also reconcile this as 100 jackets at $50 a jacket, because you know the difference between cost and NRV is 50. So there's a few ways you can go about this. It's more just understanding that you have to look at the net realizable value of how much you think you'll be able to sell this for, of a good, and how much it costs you, and you have to see which is lower. You don't need to make an adjustment where the cost is the lower of the two, because your inventory already reflects that. The problem is your inventory will be overstated if your NRV is below cost. Here's a ratio. I don't remember if we've seen this before, but it's called inventory turnover, and it's your cost of sales divided by your average inventory. This ratio reflects how many times inventory was produced or purchased and sold during the period. A higher ratio indicates that inventory moves more quickly, thus reducing storage and obsolescence costs. So how can you think about this? So I'll use a very simple example. Let's say we started with $0 worth of inventory and we bought 10 ePhones, and month 1, January, we buy 10 ePhones, we sell 10 ePhones. Okay, our cost of sales, let's say they cost us $100. Cost of sales at the end of January is $100. Month 2, we do the exact same transaction. We buy 10, we sell 10, same cost of sales. Our cost of sales is now 20. We do that every month. At the end of the year, our cost of sales is going to be 120. Our beginning inventory balance was going to be, let's say we started with inventory of 10 phones. Our ending inventory balance is still 10 phones, right? Because we just keep buying and selling the same 10 phones. Our average inventory is 10 phones or $10 worth of phones. What's going to happen is you'll see that we effectively turned over this inventory 12 times. Sorry, I got my numbers wrong. 1,200 and then 100. $100 worth of phones. We have cost of sales of 1,200 and we have average inventory of 100. That means we did this transaction 12 times, right? In theory, that's how inventory works. We buy inventory, we sell it. We don't want it sitting on our books for too long. And cost of sales represents every time we sell all that inventory, it accumulates, right? So it gives an approximation of the number of times throughout the year that we sold an average amount of inventory. Inventory and cash flows. You guys should know this already. You add a decrease in inventory or an increase in payables to net earnings. You subtract an increase in inventory or a decrease in trade payables to get from cash flow from operations. Nothing new. That's it. So